You took the trade. You were right. The chart did exactly what you said it would do. And then, 20 minutes in, you closed the position. 2 hours later, the move you predicted finished. Without you. This is the most common failure in retail trading. It is not bad analysis. It is not bad timing. It is not even bad luck. It is the inability to sit with a winning position long enough to actually collect what you forecast. Every trader knows this feeling. You've done the work. The setup was clean. The thesis was right. And then, somehow, you talked yourself out of the trade just before it paid you. Here is why it happens. And here is exactly how to fix it. The reason you sell too early is psychological, not strategic. The brain does not weigh 500 pounds of profit and 500 pounds of profit equally. It weighs the second 500 at half the value of the first. This is called diminishing marginal utility. Daniel Kahneman won a Nobel Prize describing it. In trading, this means something very specific. The first profit you see triggers a powerful urge to lock it in. Every additional pound of unrealized profit feels less important than the pound already on screen. So you close, you feel relief, you congratulate yourself for taking the win, and the trade keeps going. Without you, this is not a discipline problem, it is a wiring problem. Your brain is doing exactly what it evolved to do. It is protecting what you already have, even when the rational decision is to let the position breathe. The fix is not willpower, the fix is structural. The half-in, half-out framework removes the choice from the heat of the moment. You decide before you take the trade what you will do at each level. You write it down. You execute mechanically. There are no decisions to make once the trade is live. The plan was made when you were calm. Here is how it works. Tier 1. You enter the full position at your planned entry. Stop loss is set immediately. Risk is calculated. Position size matches your plan. You are now in. Tier 2. When price reaches your first target, typically a 1-to-1 reward to risk, you close 50% of the position. You move the stop to entry on the remaining 50%. You are now in a free trade. Your worst case from this point is break-even. Your best case is unlimited. You have removed all financial risk and kept all upside. Tier 3. The remaining 50% stays open. It runs until either price reaches your structural target, usually a Tier 1 resistance from the confluence framework, or until price reverses through your trailing stop. You are no longer fighting the urge to exit. The position fights for itself. This system does three things that solve the early exit problem completely. First, it satisfies the psychological need to lock something in. You took half the position off. You banked profit. The brain stops screaming. The pressure is released. Second, it puts you in a free trade with no further risk. You are no longer trading with money. You are trading with house money. The pressure to defend a paper profit disappears entirely. The position becomes interesting again, instead of stressful. Third, it lets you participate in the full move when it actually happens. Most weeks, half your trades will hit Tier 2 and reverse. That's fine. You locked in 1R. The remaining handful will run to Tier 3 and pay you 3 to 5R on the back half. Those are the trades that pay for the year. Now look at the numbers. If your average loss is 1R and your average Tier 2 exit is 1R, you break even on the half you take off. The other 50%, the runners, are pure expectancy. If even 1 in 3 of those runners reaches 3R, your overall expectancy is materially positive, and you have not changed your win rate at all. Same setups, same entries, same stops, different exit framework, different outcome. Look at any week of professional trading, and you will find this pattern. The pros are not better at picking entries. They are not smarter about timing. They are better at letting trades work. They have removed the urge to close at the first sign of profit by structuring the exit before the entry. This is the difference between a hobby and a craft. The hobbyist watches the chart, feels the emotion, and reacts. The professional sets the rules, then leaves the rules alone. Build the rule. Print it. Put it next to your screen. Run it on every single trade, no exceptions. Take the position, set the stop. Hit Tier 1, close half. Move stop to entry. Let the back half run to structure or trail. That is the whole framework. 5 steps. No decisions in the heat, no paper profit panic, no wondering whether to exit. The plan was made when you were calm. You execute it mechanically. Every time. The next time you close a winning trade 20 minutes in and watch it finish 2 hours later without you, remember this. The trade was not the problem. Your exit framework was the problem. Fix the framework, keep the trade. This is one of the foundational pieces in the Titan Protect framework library. Every member tier includes the full half-in, half-out methodology, plus the structural framework for setting tier targets that actually hold.